For those of you new to the channel, hit subscribe button now to keep updated on new videos that we release. You can also check us out at firstmacrocapital.com. We're an independent research firm to help individual and professional investors identify long-term cycle opportunities across multiple sectors. Today we're going to be looking at the history of equity markets, capex data, and the US dollar, history of crashes in the S&P 500, key areas to lead for investors in 2020s, what a great investor did in the last cycle. So again, let's get started here. Just a general disclaimer, we'll be making some forward-looking statements. Again, we're just an investment research firm. Please, again, do your own due diligence. This is for your informational purposes. While many are wondering how high the S&P 500 will go, when looking to past decades, what happened when all the market's attention is primarily focused on one equity geography over others? After every equity bubble, the Nikkei in the 1980s, which was the orange line, then Europe in the 1990s, you got the stocks, purple, followed by emerging markets and the OOs, the red line. Each of these markets has yet to recover from their peaks, now to today. Is the S&P 500 set up to repeat what these previous equity markets have done, unable to reach their past all-time highs? Big tech is more than 25% of the S&P 500 and the Nasdaq 100. If investors are going to be selling the S&P 500, which is primarily tech stocks, investors need to buy something else. But what is it? What would indicate we're approaching the top of the S&P 500? First, we look at we previously mentioned the consumer confidence, which is an excellent measure for tops in the equity market. We've also have a slowdown in core capex orders on a year-over-year basis, which is highlighting a peak in the S&P 500 is very near, with expectations 2019 Q4 GDP expected to be almost near zero. This all coincides with the top in the US dollar. We can see here there in the 1990s, the US dollar was very strong, just like over this past decade. And which sector was primarily driving this in the 1990s and today? The tech market. So if the tech sector is coming to an end like in the 1990s like today, well, investors are going to be selling out of the not only tech but the overall US market, which is not good for the US dollar. During the last commodity cycle, the S&P 500 was essentially flat from 2001 to 2008, and was down even further when you adjust for the fall in the US dollar on a trade-weighted index basis that fell from 130 to 100 during that time period. If money flows out of the US as we finish this cycle and enter the next cycle, where will the money go? First off, it's the emerging market countries that are expected to power ahead of the world's growth over the next 4 to 5 years. As we can see in this table, where on the left-hand side in 2019, China, US, and India were the three primary drivers, and all other countries combined was 14.1%. The US accounted for 13.8% of the world's growth in 2019. With expectations, it will be only 9.2% of the growth in 2024. This is not good for both the US dollar and US equities. It is good for commodity countries within emerging markets, which we think will surprise investors to the upside because of the rotation into commodities during this time period. Brazil, in US dollar terms, Brazil and Russia have outperformed the S&P 500 since 2016, and we think they're only getting started. Why? Their economies are heavily weighted to commodities and will benefit from an accelerating commodity. Could we see this again? Look what happened here. Billionaire investor Warren Buffett said on Thursday he's been buying the Brazilian real currency, noting that it's doubled over the past 5 years against the US dollar. Could we see this again, where other legendary investors start to pile into foreign currencies, particularly the commodity-weighted ones like Brazil or even the ruble? Even legendary investor was willing to invest in emerging markets during this last cycle. Brazil has both the combination of emerging markets and being a commodity country. Emerging market stocks are back to the 2003 lows relative to the S&P 500. Emerging markets in dollar terms continue to set higher lows since 2002. After being in a decade of sideways trading, a breakout is potentially coming in 2020. We'll let it show us the way and avoid any near-term value traps, but it's potentially setting up for a massive upside being in emerging markets relative to the S&P 500. Let's be clear, a blow-off top in the US stocks is 100% possible. We're in it, and our clients know that it was totally possible back in May 2019. The US equity bubble ending will lead to a weaker US dollar and will be the catalyst for non-US dollar assets like emerging markets and commodities going forward. There's greater upside to emerging markets and commodities. If you're not willing to look at commodities and emerging markets now over the next year or two, it could take another 20 to 30 years before you see this opportunity in terms of risk-reward setup, which is setting up for a once-in-a-generation opportunity. The S&P 500 will be the market to avoid in the 2020s if history repeats like past equity cycles. But we're most excited in emerging markets and commodities in 2020 and beyond. Thanks for joining us. Remember to hit subscribe. Check us out at firstmacrocapital.com, where we cover new sectors every month. Monthly subscription is $89 a month, no hidden fees, no hassle, cancel at any time. Stop guessing and focus on understanding the cycle. Sign up today at firstmacrocapital.com.